Co-founder and wealth advisor at VestGen Wealth Partners. Thanks for being on the show, Craig.
Hey, good morning and a very happy Friday to you. This thing could have come in too hot. It could have come in too cold. Not just about right, but A-okay. Average hourly earnings, that's what I was concerned about month over month, 0.3%, and unemployment rate on the headline side of 4.4.
Oh.
Hey, Scott, that's only 4.4. And as long as we did jobs somewhere in that 50 to 125,000 range, I think it's a decent number. And that's exactly what we got, because a number here with tame wages still allows us to get some Fed rate cuts later this year. And it definitely shows that we're not having a growth scare. So, hey, I'm all smiles going into the Chicago Bears game against the Green Bay Packers on Saturday.
Well, yeah, it's 50. I had right down here 66,000 was expected, so we had 50. You're right, average hour earnings 0.3 cents per print. That was what was expected, a little hotter than last month's. But, yeah, I mean, I think it's here's my issue, though. Yeah, it's okay. That's not going to really screw the market up here today. But you know what, Craig? I mean, I've been doing it a long time. We've got stocks hitting all-time record highs. We got 4.3% GDP last read. People talking about a 5%. We've got double-digit earnings growth when we come to the stock market. Those are all not reasons to cut rates. Now, I know that everybody's going to talk about jobs, but a 4.4% unemployment rate, and nothing was too crazy in the JOLTS numbers and the quits numbers this week. I mean, what do we do if we really get in trouble, I guess, is a question, because it seems like we're cutting rates not for good enough reasons.
Well, I think the Fed's trying. I can't defend the Fed. I'm not sure what they're doing because I don't work there. But I think the Fed realizes that we've been for so long in this no hire, no fire labor market, which I think has moved to a no hire, very low fire.
I agree.
But then the next step is not very low fire, to then more fire, to then even more fire. It's coming, guys. It's coming because of the artificial intelligence and so many of the job creators in America. It's our listening audience. It's these independent business owners. It's the people who feed the world. But think of small business, right? Think of all the companies in the S&P 600, in the S&P 400. We're so focused on the Dow and the S&P 5. There's all these small businesses. And if you can continue to find ways to lower the cost of borrowing and reduce the headline unemployment number, I think we maintain the consumer spending and we starve off the inevitable. It is inevitable. I just don't want to get there any faster than I need to, and that's why I support the Fed in cutting rates and focusing on this labor market.
But do you take my points? I mean, do you understand where I'm coming from? I mean, it's
I do.
Yeah,
I do because I can't deny it's a good recipe. I mean, You just said it. The double-digit earnings growth, the GDP, the gross domestic product, this U.S. economy, it's not faltering. It is on strong footing. So it raises the question for everyone who's grown up with markets saying, hey, why are we doing this? Because I know you're worried, as many people are, about a potential flare back up in inflation, a potential flare back up in 10-year Treasury yields. Both of those are big dangers. I get it. But I think right now, Jerome Powell on his way out, I think he's going to be happy to go because I think the next Fed chair is going to have such a more difficult time, but I think he's done masterfully well in navigating these waters thus far.
So let me ask the last question before you go. What is your personal opinion? I mean, I'll tell you what mine is about jobs. I think, and a lot of people are arguing with me about this, but I do feel like artificial intelligence really was meant to be more productive and efficient and get rid of the human worker. That's what I feel like a lot of it was put out there for, and robots obviously would be in that camp. So I don't feel like we're going to replacing workers with old skills with workers with new skills. I think we're going to replacing workers with machines. That's why I think maybe the Fed's maybe worried, but at the same time, I don't think interest rate cuts are going to stop the machines putting people out of work. What say you?
No, no, no. Structurally, the Fed can't do anything about unemployment. They can't. They can just delay the adoption of this larger unemployment that's coming. We're definitely finishing in the year, in my own opinion, with a headline unemployment number that starts with a 5. And even when I look back over the last 15, 20 years, everyone points to global outsourcing, and all these other things for changes in the labor market. It has always been innovation coming from technology that creates disruption. And AI right now is enhancing the human experience. We leverage it tremendously, but AI is going to be replacing workers. Undeniable. Everybody knows it. And we just need to culturally start getting there, getting ready for it, because it's not just job replacement. I think we're talking about large swaths of the country being underemployed, which is almost as dangerous as being not employed.
Right, and that's why I think we're in for an interesting time here, and it's going to be difficult. And look, you're talking to a guy that got displaced from electronics and machines and technology when we got rid of the trading floors. So I know I don't take this lightly, but we're going to have a decent economy, probably a decent market, but we're going to have a lot of people lose their jobs, which is kind of odd. That's not really something that we've had happen before. 10 seconds to you before we go.
No, you know what? No one's comfortable with it, but it's the reality, and that's why I encourage everyone listening, be thinking critically. What can I be investing in that artificial intelligence isn't going to replace, and what is artificial intelligence not going to reprice?
As I had a buddy of mine when the floors were going away in London, they went away earlier than they did here. In 1997, we got rid of the trading floors and mechanized everything. But we were out having a couple of pints in the pub, and a buddy of mine that also made the switch to, upstairs at a bank. We survived the cuts, but his dad met us, and his dad was a big construction guy in London, and he just looked at us and said, "I'm glad I'm not you guys, because you know what, you're always going to need a guy to hang a door." And I thought, you know what, the guy's right. There's going to be some things that probably are going to take a lot longer to replace than a bunch of guys sitting around yelling and screaming all day. There's always going to be somebody that needs to put those hinges on and hang that door, and he's right. So got to kind of look for those types of things, and we may get those with the data centers and the things that we're starting up, so who knows. But it's going to be an interesting time. I appreciate you coming on. Thank you very much, Craig. Have a great weekend. Craig Bolanos, he's the co-founder and wealth partner at VestGen Wealth Advisors up in Chicago.